And welcome back. So you've now completed step 2, setting up your income. Now we're on to step 3. So go ahead and just click next if you're not there already. And now we're going to put in the retirement savings plans. These might be things that you're contributing to out of your check. It could be something like a health savings account, an IRA, a Roth, anything that you're putting money away into. Now remember, for John, we assumed he was 50 years old. We also assumed that he was making, I think, $75,000 per year. So what we're going to do is we're going to put, say, 20% of his income away, and that's already started. So he's already been putting that away. Now, the primary match, what is this? Well, you can always just click on these little bubbles, and it says this reflects the percentage of the client's contribution that will be matched by the employer. And let's assume that out of the 20%, they're going to match 50%. So that's 10% that he's going to put away. So the primary match too, it says this reflects the maximum percentage of the client's salary that the employer will match. So they're going to match 50% of what he puts in, which is 10%, up to a maximum of 3%. Now, some companies have secondary matches. These are bonuses. If you find that you have those with your company, it's pretty simple to put them there. However, if you have maybe a flat percentage match, this is where, or a matched dollar. This could be like a profit sharing plan. This is where they're going to put in a certain amount on an annual basis based upon your income or just a flat amount. And then the last little bubble here is the self-employment. You're going to click on this if you have your own company and you're putting away into such things as a SEP, a unit 401k, or a simplified 401k. This way it'll figure out what that contribution limit is. Now, the question I always get is, should I put this entry if I'm using my own defined benefit program? That would be something such as a 412. So a 412, if you're self-employed, you're putting the money away. It goes in before tax, just like a 401k. The big difference is with a 401k, you're still going to pay Social Security and Medicare tax on it. That equals 7.65%. So that's quite a bit of money. If you're using something like a 412, click on this box, and it will subtract the amount from your tax analysis of that 7.65 of the contribution percentage that you're putting in. Go ahead and just hit save, and let's come over here into maybe a taxable investment. Let's say that you are putting money away into an annuity. I'm not telling you that's bad or good. Some people are doing it. Let's say that you're putting away $25,000 per year into that. Well, let's reduce that. John's only making $75,000 a year. He's already putting away 20% into his employer pension plan. John is the owner of it, means that that's the person that's putting it away. Now, in this particular case, you could put it away as joint. So it's John and Mary putting that money away. Assuming you've already started it, meaning that you're not saying you're going to start it in the future, you're already starting it. So what we're going to do is leave the annual increase at 0 unless you are planning on increasing it every single year. Now, it's important to understand what the target is. So if you are self-employed, and we're going to go back to the employer retirement plan, go ahead and click on, if you're self-employed, what that will change is when you add a taxable investment, I'll let you read it right here, target, the percent will be applied to salary. If the self-employed at the bottom of the savings card is checked, the percent will be applied to the self-employment income. Again, that's here, and also where your salary was coming in back in income, whether that was self-employed income or not. So we're just going to go ahead and hit save. And we didn't save anything. Let's go back and put that in. That's $15,000. Already started. We'll assume no annual increase. We'll assume that the target is just annual dollar amount of $15,000, not a percentage of the self-employment income. And we're going to stop this savings when John actually retires. Now, up in add savings, we can add any type of savings that we want. So let's add a health savings account. So John's HSA. Now again, we have to have an HSA qualified insurance policy, and let's say that we're adding in $6,700 per year and it's already started. We're going to put in the annual amount versus a percentage of income, and the savings is going to end at John's retirement. Let's actually end it at age 67, because when Medicare kicks in, we can't add to John's HSA anymore. Actually, I think we have him retire at 65, so we'll take Medicare at 65, and we're going to take the HSA account into his savings plan. And under other, so cash balance pension, a profit sharing plan, tax deferred, this might be the annuity. And let's put in a cash balance plan, because this might be one of those types of plans that you put into where it does not tax the Social Security. So John's cash balance plan, his CBP. And let's say he's putting $10,000 into here. And again, this would have to be applied if he has self-employment. If he has the employer retirement plan, you might not have a cash balance plan. But I would tell you that most physicians, dentists, people that are self-employed that have high incomes might utilize something like a cash balance plan. Most people that aren't self-employed are going to use the employer retirement plan within a 401k. So what we're going to do is we're just going to go ahead and get rid of that one. And let's see if there's anything else in here. Let's put in a Roth. Now, the interesting thing with a 529, let's talk about that one. We'll put the Roth in just a second. So we have the Roth 529. When you save for this, what's going to happen is it will not allow you to utilize this for your own income, for your own retirement. You have to force it out at the end, because remember, a 529 is typically used for children's or grandchildren's college. So if there was $5,000 that was added to that amount, to that account, then we're assuming that $5,000 a year gets saved. Now, if you do have children that are going to college, later on when we get to expenses and we get to goals, this is where you're going to be able to say, I want to utilize that 529 tax savings. The program will allow you to determine what accounts to take out of first that are either more tax efficient than others. So let's review this again. Once you have your base, you can add your base account set up. You can add any one of these other types of accounts, such as your solo 401k, a 401a, which is typically for school teachers or some people that are have those special programs through government agencies. We have the traditional IRA and the Roth. Now, question is, what's a backdoor Roth? Let's just throw this up there just so you can understand it. So a backdoor Roth is when you do not qualify because your income is too high in order to put money into a Roth. However, you may be able to put money into an IRA. So what a backdoor Roth is you contribute the money to the IRA. As soon as the money hits the account, you then convert it to a Roth. Now, when you add it into the IRA, it's considered a non-deductible contribution. So when you reach certain income limits, they still allow you to add it into an IRA, but you can't take the deduction on it. So it's called a non-deductible IRA. However, the way a non-deductible IRA works is as time goes on, the money will grow within the IRA, tax deferred. However, IRAs have a draconian end result to them in that when you reach age 72, they force you to take income out. Whatever the ratio is of what you added in non-deductible contributions versus or divided into the total balance. So here's the example. If I put away $5,000 a year, in 10 years I put away $50,000. At the end of the 10 years, if I have $100,000, I have a 50-50 ratio. If they require me to take out $5,000 per year in a required minimum distribution, $5,000 of it is going to be taxable, $5,000 will be tax-free. It's that ratio. However, if what I did was I added the money to the IRA, remember it's a non-deductible IRA, and then thereafter I converted it to a Roth. It's not an extra tax because you didn't get a deduction on the IRA to begin with. Now the money is growing inside the Roth. If I use the same numbers, I put away $5,000 a year. I put away $50,000 after 10 years. If the Roth, because we're assuming they're both invested in the same thing, is now worth $100,000, I don't have a required minimum distribution. And that $50,000 of gain is 100% tax-free. So a backdoor Roth is really used again when your income is too high to take a tax deduction on. Let's go back into the Roth. And we'll just add the same thing. As you can see, adding items into any part of the Wiser Retire system is very simple. Doesn't ask for a lot because we're going to refine some things as we get to the next section. So that is it for step 3, savings. Please progress to the next video.